What is going on, YouTube? Welcome back to Jake Ferb Finance. I am Jake Ferb. Today we're going to be talking about interest. I'm going to break down interest and show you how it can actually be a good thing for you and how it works in our day-to-day lives. Let's get it. So guys, most of us know about interest and we know of it as generally a pretty bad thing. We know the concept of having to pay extra just for taking out a loan, and it's basically just the price that you have to pay to be able to pay the banks back over time. So we know the bad parts about it and how it's just the extra part of the loan that's on top of your principal and how you have to pay back more to the banks than what you actually took out. And we know of it being really bad in the sense of credit cards and being all right in the sense of auto loans and pretty good actually in the sense of mortgages, especially fixed rate mortgages. But let's take a look at how it works and let's look through some math. So here, guys, you can see that it's really not as easy as it should be to figure out these payments, and that's because you have to take down the amount off the principal that you're paying each year. So you can't just multiply by the interest rate and get your total price and then divide that by your total number of payments, because you're going to be paying less in interest each year because you're paying down the actual loan and you're paying down the principal of the loan. So you can take a look at this if you really want to. Here's the formula for it, and here's how you figure it out. But you really are never going to have to do this because there's plenty of mortgage calculators online. So let's say that you're looking to buy, $450,000 house. So I guess I can type it in. So we'll start with $450,000. And you're going to make a down payment in an investment property or a property that you're intending to rent out to other people. You're going to have to pay about 15 to 20% down. But in a property that you're actually going to live in, it's going to be more around 5%. So it's going to be a $22,500 down payment, and that's going to be money that you're going to have to save up if you'd like to buy a house. Now, usually you'll get a 30-year, fixed rate mortgage. That's the best option, especially if the interest rates are low like they are right now. And so if your interest rate on good credit is, 3.375, then you can just plug all that stuff in here, guys, and figure it out really easily. And this will be your monthly payment about, obviously there's going to be some property taxes, which you can add yourself, and all this, the HOA fees. And that's going to be kind of an example of a way that interest is working against you. Now let's look at another example. So guys, this is really the worst situation for interest. When interest is at its worst, it's in credit cards, especially credit cards that target people with bad credit, people with no credit. These high interest rate cards are going to be an absolute nightmare. This is actually a pretty solid interest rate for a credit card, 19.99%. Won't be too uncommon to see, 26.99% or 24.99% on an interest rate on a new credit card, like one of your first credit cards or a credit card that is targeted to you after you tank your credit score or something like that. Now, I've gone ahead and done a conservative estimate of only charging $1,000 to this credit card and saying if you make the minimum payment each month, how long would it take? You'd end up paying $1,170.90 in total interest, and this would take you 7.3 years to pay off the entire balance if you were only paying $25 a month. Now, you might say, well, okay, I can pay more than $25 a month. I'm going to make some more money in the future. I might make my minimum payment once or twice, but I'm not going to always make it. So let's say you pay $100 a month, which, is still kind of a low estimate. You'd still pay $100 in interest if you were only paying this. This is why I always advocate to never leave a balance on a credit card. Now, what you see is people get into trouble is because they keep spending on the credit card because that's how they get their money. That's how they get their things, is from putting it on the credit card and using money that they don't have. So this number is going to be more like $10,000 or $15,000 in credit card loans that they've taken out and that money that they don't have. And then if they're saying, okay, I'm going to put $200 towards this every single month and start paying this down. Look at this. It doesn't even let me do it on the website. I didn't plan this. I didn't know. But it says number of payments exceeds 600. Guys, so let's up this percent. Maybe it'll be 5% even so that we can actually up it. But it would take you over 600 monthly payments to pay that off at a 24% interest rate at $200 a month. $9,000 in interest it's going to make you pay if you have this high minimum payment percent on this original loan. You're going to be paying $24,000 total on this loan if you get into a bunch of credit card debt. Now, this is interest at its absolute worst. It'll take you 6 years to pay off, 71 monthly payments, and a ton of total interest. All right, guys, so you've seen how interest can be bad. You've seen interest at its absolute worst. So what's a way that interest can actually be good for you and work for you? Now remember, it's the price of borrowing money over time, so you're paying an interest rate. What that rate is actually, representing is that the bank is saying, okay, we'll allow you to pay this money off over a certain amount of time. If it's a car loan, maybe 5 years. If it's a mortgage, maybe 30 years. But it's the price that you have to pay to the bank for them to give you the money now and allow you to pay them back over this certain amount of time. So how can that work for you? Let me introduce you guys to savings accounts, and especially high yield savings accounts. These accounts pay you interest for keeping your money in the account. Now, why would they do this? How is this possible? Guys, there's one reason that this is all possible. Because the money that you have in your bank isn't really all there. Now, let me explain. When you deposit money into a bank, whether that be a checking account or a savings account, they have enough money total to make up for it. And if you'd like to withdraw it all, you probably can. But what they're really doing with the money that everybody's depositing in a savings account and in their checking account is borrowing that money. That's the bank taking your money and giving it to other people or investing for themselves. They use your money to do this. So you have that arbitrary number on the screen of, hey, I have $100 in my checking account, but it's not really there. You just have the comfort of knowing that you could get that $100 at any time, but your $100 that you deposited into the bank, that is the bank's money now, and they are borrowing that from you for whatever they need it for. So companies will pay you interest to keep your money in their savings account so that they can borrow it and do what they need with it. So like we said, we gave it a definition earlier. This is the price that the banks are paying you in order to borrow your money and pay it back over time as you need it, as you make withdrawals, as you make payments. So it's the banks doing the same thing to you that you are doing to them when you pay interest to the bank. They're now paying interest to you for borrowing your money that you deposit with them. And that's a good thing for you, and you want the interest rates to go up on these accounts so that you make more money every single year. As for savings accounts and high yield savings accounts that I recommend, obviously I gave you a little bit of a sneak peek earlier. Ally Bank has never done me wrong. I have had no problems, and they have a great savings account. This is not a very high interest rate. It used to be, up in like the 2.2%, 2.25%. But as, the Fed lowers interest rates, it lowers your interest rates on car loans and on mortgages, so you get better deals for that, but it also is going to lower the interest rate that banks can pay you to keep money with them. So interest rates going down is good for most people, but it's not all good. Ally Bank also has an interest checking account, and if you keep enough money with them, then they'll actually pay you interest a tiny bit. It's like 0.1% on the money that you leave in your checking account. So it's not very good. It's not, a lot of money. It's not a very high interest rate, but it is something, and most banks, especially checking accounts, will not offer anything. So that's another good thing that Ally Bank does. So guys, now you've learned that interest is not all bad, and that it's only bad in some certain scenarios, like high interest credit cards, and how bad that can actually burn you. Interest, guys, even on a mortgage, is not even that bad, because as long as the interest rate is under about 7 to 8%, you can make the rest up, and you can make up the difference by investing in the stock market, investing in index funds, which will have another video coming out soon, and making a 7 to 8% return on that money. Then you can pay off your interest with that and keep the difference, which is going to be 4 or 5% if you have a 3 or 4% mortgage interest rate. So interest is really not all bad, guys. It gets kind of a bad rap, except on credit cards. Now that you've looked at that, you can go about your day-to-day life and be a little bit smarter about interest. Have a good one, guys. I'll see you in the next one.